Warren Buffett has said he will never pay a dividend as long as he is alive. He has held to that commitment for decades. Berkshire Hathaway, one of the most widely held, most respected, most analyzed, and most admired companies in the history of the stock market, pays its shareholders exactly $0 in annual income. And for income investors who genuinely believe in Buffett's philosophy of selecting exceptional businesses at fair prices and holding them for the long term, that has always been the fundamental tension at the heart of owning Berkshire. You are invested with arguably the greatest capital allocator who has ever lived, sitting in a portfolio of genuinely excellent businesses, and your portfolio generates no cash for you whatsoever. There is now an ETF specifically designed to resolve that tension. OMAH, the Vista Shares Target 15 Berkshire Select Income ETF, holds Berkshire Hathaway itself as its largest position, and then replicates the 20 largest individual stock holdings inside Berkshire's own portfolio in their correct proportions, giving investors direct ownership of the specific companies Buffett has spent decades selecting. On top of that equity foundation, the fund writes covered calls across those holdings to generate a targeted 15% annual income paid out monthly at approximately 1.25% per month. You get the portfolio Warren Buffett built. You get exposure to the businesses he has identified as the best long-term value compounders in the American economy. And you collect the income that Berkshire itself categorically refuses to pay. Today on Dividend Desk, we are doing the complete breakdown of OMAH, what it holds, why this specific portfolio was chosen as the underlying, how the options overlay actually works, what the 15% income target means in practice, and whether it is sustainable. The expense ratio and what you are paying for, the two specific investor profiles this fund is designed to serve, the risks that every investor needs to understand clearly, and the broader context of Vista Shares as a firm, and where OMAH fits in their product roadmap. This is a genuinely novel concept in the income ETF space, and it deserves serious, thorough analysis. Quick disclaimer before anything else: nothing in this video is financial, investment, or tax advice. I am not a financial advisor. Everything here is purely educational. Please always do your own research and consult a qualified professional before making any investment decisions. Let's start with a question that almost never gets asked seriously in the income investing conversation. Why Berkshire Hathaway specifically as the underlying equity portfolio? The answer starts with understanding what Berkshire actually is and what it represents as an investment vehicle. Berkshire Hathaway is not a typical company. It is simultaneously a publicly traded holding company, an operating conglomerate, and a publicly disclosed investment portfolio, all wrapped into one structure. When you own Berkshire, you own a piece of dozens of wholly owned businesses that generate real operating income from insurance, railroads, utilities, manufacturing, retail, and financial services. You also own a substantial and publicly disclosed portfolio of public equities that Berkshire manages as investments. And you benefit from the extraordinary capital allocation decisions that Buffett and his team have made over 50-plus years of operation. The annual Berkshire shareholder letters are studied obsessively by investors worldwide, not because they are marketing documents, but because they are genuine windows into how one of the most successful investors in history thinks about valuation, competitive moats, management quality, and long-term business dynamics. The 13F filings that Berkshire submits to the SEC every quarter reveal exactly what public equities the company owns and in what quantities, which means any investor can see and replicate the public equity portion of Berkshire's portfolio with complete transparency. This is not like trying to replicate a hedge fund's secret strategy. Berkshire's public equity holdings are a matter of public record, updated quarterly, and they represent decades of refined thinking about what constitutes a truly excellent business worth owning for the long term. The specific equities that have earned a place in Berkshire's public portfolio share certain characteristics that reflect Buffett's accumulated investment wisdom. They tend to be businesses with durable competitive advantages, what Buffett famously calls economic moats that protect their profitability from competitive erosion over long periods. They tend to have strong, predictable cash flow generation. They tend to be run by management teams Buffett trusts. And they tend to be purchased at prices Buffett views as reasonable relative to their long-term earnings power. This is a fundamentally different selection process from a market cap-weighted index that simply owns the largest companies because they are the largest, or a momentum strategy that owns whatever has been going up recently. Berkshire's public equity portfolio represents a concentrated, high-conviction, value-conscious approach to business ownership. The obvious objection to OMAH's underlying portfolio construct is this: Berkshire's quarterly 13F filings show you what Buffett owned as of 45 days ago. They do not show you real-time holdings. They do not show you the reasoning behind recent changes, and they do not give you advance notice of what Buffett is buying or selling. This is a legitimate limitation. OMAH is not going to track Buffett's moves in real time. It is going to hold a snapshot of Berkshire's disclosed public equity portfolio that is inherently somewhat lagged relative to Berkshire's actual current positioning. For long-term investors, this matters less than it might seem, because the Berkshire approach is defined by its long holding periods. Buffett does not typically flip positions quarterly. His core holdings Apple, American Express, Coca-Cola, Bank of America, Chevron have been held for years and in some cases decades. The lag between what Berkshire actually holds and what a fund replicating its 13F disclosures holds is therefore generally modest in practical terms. Now let's go through OMAH's actual portfolio construction in detail. The fund holds 21 equity securities. The largest is BRK.B Berkshire Hathaway B shares, which are the more affordable and liquid class of Berkshire stock. This direct Berkshire ownership is itself meaningful. BRK.B gives OMAH investors exposure to the full scope of what Berkshire is. The operating businesses, the float from the insurance operations, the cash reserves that Buffett has been allowing to accumulate, and the overall capital allocation acumen of the Berkshire management team. As of the most recent reporting periods, Berkshire holds approximately $300 billion or more in cash and short-term treasury holdings, an enormous reserve that provides optionality to make significant acquisitions or equity purchases when the right opportunity presents itself. The remaining 20 positions in OMAH mirror the next 20 largest public equity holdings inside Berkshire's portfolio. At the time of the most recent filings, these include some of the most recognizable company names in the American economy. Apple, which has become Berkshire's largest single equity position and reflects Buffett's recognition that the iPhone ecosystem is one of the most durable consumer franchises in history. Bank of America, reflecting Berkshire's long familiarity with and confidence in the banking sector. American Express, a holding Berkshire has maintained for decades as one of the clearest examples of a business with an extraordinary network effect moat. Coca-Cola, perhaps the most iconic long-term Berkshire holding representing the ultimate consumer franchise. Chevron, reflecting Berkshire's more recent significant energy sector allocation, and a range of other large-cap American businesses that have passed Buffett's stringent selection criteria over varying periods. What is striking when you look at the full list is the concentration. Berkshire does not hold a broadly diversified portfolio of hundreds of companies. It holds a relatively small number of positions with high conviction, sized meaningfully enough that they actually matter to the overall portfolio. This reflects a core Buffett principle. Genuine diversification at the idea level, understanding businesses deeply, and selecting the best ones rather than mathematical diversification across hundreds of names you understand only superficially. OMAH inherits this concentration philosophy, which means it is not a broad market fund with smoothed-out volatility. It is a concentrated collection of what one of the world's most respected investors has decided represents the best opportunities in public equities. The Apple weighting deserves specific mention because it represents something that surprises many people who think of Berkshire primarily as a value investing vehicle focused on old economy businesses. Apple is now the largest or second largest individual equity holding in Berkshire depending on the timing of the most recent disclosure, and reflects a significant evolution in how Buffett thinks about technology companies. His traditional reluctance to invest in technology was always fundamentally about his difficulty in projecting the long-term competitive dynamics of most tech businesses. Apple, he ultimately concluded, is not primarily a technology company in the analytical sense. It is a consumer products and services company with a loyalty and switching cost ecosystem that is as durable as any consumer franchise he has ever seen. iPhone users do not leave Apple. The App Store creates recurring revenue. Apple Pay, iCloud, and the broader services ecosystem create multiple revenue streams from an installed base that grows and deepens over time. From a Buffett analytical framework, Apple fits his criteria better than most traditional consumer staples companies at the prices he was able to acquire it. OMAH investors therefore carry meaningful Apple exposure as a natural consequence of replicating Berkshire's public equity portfolio. Now let's turn to the income overlay, because this is the mechanism that transforms a Buffett-style equity portfolio into a monthly income generator. OMAH writes covered calls on the individual equity holdings in its portfolio. A covered call is one of the most straightforward options strategies available. You own a stock, and you sell someone else the right to buy that stock from you at a specified price, the strike price on or before a specified date, the expiration date. In exchange for granting that right, you collect a cash premium immediately. If the stock stays below the strike price by expiration, the call expires worthless, you keep the premium and you still own the stock. If the stock rises above the strike price, the call buyer exercises their right to purchase your shares at the strike. You sell at that price and keep the premium, and you have capped your gain above the strike level for that period. The premium income collected from selling covered calls is what OMAH distributes to investors as its monthly income. The amount of premium available depends on several factors. The implied volatility of the underlying stock, how much price movement the options market is pricing in the distance between the current stock price and the strike price, and the time until expiration. Higher implied volatility, calls written closer to the current stock price, and longer expiration dates all generate more premium. Lower volatility, calls written further out of the money, and shorter durations generate less. OMAH's investment committee manages these parameters dynamically rather than mechanically. The options strategy is not set on a fixed schedule where calls are written at a predetermined strike and held to expiration regardless of what happens. The portfolio managers monitor the positions continuously, looking for both risk management opportunities and income capture opportunities. The example of banking essentially all of a month's targeted income in the first week of operation possible, because a spike in market volatility made call premiums temporarily much richer illustrates how the active oversight layer can add value relative to a purely mechanical approach. A rules-based system with a fixed schedule would have spread that income capture across the full month. An active team recognizing the opportunity can front-run the calendar and lock in the income early, reducing exposure to subsequent volatility. The use of call spreads in addition to straightforward covered calls is a distinguishing feature worth understanding. A call spread involves selling a call option at one strike price and simultaneously buying a call option at a higher strike price. The premium collected is the difference between what you received for selling the lower strike call and what you paid for buying the higher strike call, less than a simple covered call would generate in isolation. But the call spread structure means that if the underlying stock rallies dramatically, the bought call at the higher strike partially offsets the losses from being short the lower strike call, allowing the fund to participate in more upside than a flat covered call would allow. OMAH uses call spreads specifically in scenarios where a significant market or individual stock drawdown has created the potential for a sharp snapback recovery. Rather than writing flat calls and capping all the recovery upside, the call spread structure lets the fund capture premium income while still participating meaningfully if the stock recovers strongly. This is a more sophisticated approach than simply writing calls at a fixed percentage above current prices every month. The question of how OMAH handles the individual names in Berkshire's portfolio that have lower implied volatility and therefore generate less call premium is handled through the flexibility to use index options as a supplement when needed. If a specific holding does not have enough volatility or options liquidity to generate meaningful premium from individual calls, the fund can write options on a broader index as a proxy. This prevents the income generation from being handicapped by the specific volatility characteristics of any individual position and ensures the overall portfolio consistently targets the 15% annual income rate. Let's talk about that 15% target specifically, because it is both the most attractive and the most important number in the entire OMAH proposition. In the income ETF landscape, 15% annual income sits in an interesting middle ground. It is meaningfully higher than the 10 to 12% targeted by the most established and well-regarded covered call ETFs products that have demonstrated multi-year track records of generating their targets from genuine options premium rather than capital erosion. And it is meaningfully lower than the 20 to 40% and higher yields advertised by some of the most aggressive income products in the market products, where a significant portion of the headline yield is frequently funded by returning investors' own capital to them dressed up as income, systematically eroding the NAV over time. The 15% target is achievable from genuine options premium generation under reasonable market volatility assumptions, but it is not achievable with zero cost to the underlying equity appreciation. This is the central trade-off of every covered call strategy, and it deserves honest treatment rather than being glossed over with the excitement of a high yield number. When you write covered calls on your equity positions, you are selling some portion of the future upside of those positions in exchange for income today. If the S&P 500 runs 30% in a year, as it has done in certain recent periods, a fund that has written covered calls throughout the year might capture 15 to 18% of that move, while also collecting its call premium income. The total return might actually exceed pure equity holding in a flat or modestly rising market, because the premium income more than compensates for the occasional upside cap. But in a strongly rising market, where the underlying stocks are frequently rallying past the strike prices, the fund will lag the uncapped equity performance even as it is generating meaningful income. This is not a flaw in the strategy, it is the explicit trade-off being made. Income today versus full upside participation tomorrow. For Berkshire Hathaway specifically, this trade-off has a particular character. Berkshire itself is not a high-growth technology fund. Its long-term performance has been extraordinary by any measure, but it does not typically generate the kind of 30 to 50% annual returns in a single year that would make a covered call strategy look extremely costly in hindsight. Berkshire tends to be a steady, value-oriented compounder, the kind of portfolio where selling covered calls makes structural sense because you are not regularly giving up enormous upside moves. The companies in Berkshire's portfolio are generally well-established, financially strong businesses where the expected long-term returns are excellent but rarely in the category of explosive short-term appreciation. Writing calls against that kind of portfolio is a more favorable trade-off than writing calls against, say, a pure high-growth technology fund where the upside potential in any given year might be extraordinary. The sustainability of the 15% target is ultimately a function of whether the average implied volatility of the portfolio holdings is high enough, over time and across varied market environments, to generate that level of premium income consistently. In a period of very low market volatility like the extended low volatility period from 2012 to 2017, call premiums compress significantly, and income targets like 15% become harder to achieve without writing calls much closer to the current stock price, which in turn means the upside cap becomes more binding. This is a genuine risk that investors should acknowledge rather than dismiss. Vista Shares notes the flexibility to use index options when individual name premiums are insufficient, which is one mechanism for managing this risk, but the fundamental constraint of a low volatility environment is real for any covered call income strategy. The expense ratio of 95 basis points deserves its own discussion, because it is one of the more common objections to active income ETFs from investors accustomed to the razor-thin fees of passive index funds. A Vanguard S&P 500 index fund charges 3 basis points. OMAH charges 95 basis points. On a $100,000 investment, the difference is $920 per year. In the context of a fund targeting $15,000 in annual income distributions from that same $100,000, paying $920 in management fees to have an experienced team handle the options strategy, monitor the individual positions, make rolling decisions, manage the risk overlay, operate the investment committee, and ensure the distributions land consistently is genuinely reasonable. Managing a covered call program across 21 individual equity positions is not a passive activity. It requires daily monitoring of options pricing, continuous evaluation of where the strikes should be set given current volatility and price levels, active decisions about when to roll positions early versus holding to expiration, and ongoing risk management to ensure the income targets are being met without compromising the underlying portfolio. The professional expertise required to do this well, built up over decades of options market experience, is exactly what you're paying for at 95 basis points. Comparable covered call ETFs from established issuers targeting 10 to 12% annual income charge in the range of 65 to 75 basis points. OMAH charges approximately 25 to 30 additional basis points and targets an additional 3 to 5% of annual income. Whether that trade-off more income for a modestly higher fee is attractive depends on your income needs and your confidence in the options management team's ability to deliver the additional premium consistently. Now let's clearly articulate the two investor profiles for whom OMAH makes the most sense, because this is not a fund for everyone, and being clear about who it is designed for is more useful than vague enthusiasm. The first profile is the income-focused investor who wants a well-constructed, high-quality equity core, but needs that core to generate meaningful monthly cash. This is an investor who appreciates the Buffett investment philosophy, selecting excellent businesses at fair prices, holding for the long term, concentrating in high-conviction positions, but cannot afford to have their portfolio sitting in non-dividend-paying equity without any cash generation. For this investor, OMAH offers access to one of the most admired equity portfolios in the world in a structure that actually pays them every month. The underlying businesses are not speculative growth companies trading at extreme valuations. They are well-established, financially strong, thoroughly analyzed enterprises that Buffett's team has determined represent compelling long-term value. The monthly income is not manufactured through financial engineering that erodes the capital base it is generated from selling call options against those same high-quality positions. For an income investor who would otherwise own a broadly diversified dividend ETF at 3 to 4% yield, OMAH represents a dramatically higher income rate from an underlying portfolio that is arguably as well curated as any available. The second profile is the existing Berkshire Hathaway investor who is income-focused and frustrated by the complete absence of distributions. This investor believes in Buffett, owns BRK.B, and has benefited from Berkshire's long-term compounding. But as they approach or enter retirement, the absence of any income from Berkshire becomes a practical problem. They need their investments to generate cash to live on without having to make sell decisions. The traditional solution is to sell some Berkshire shares periodically to generate income, but this creates tax events, requires timing decisions, and systematically reduces the position. OMAH offers an alternative. Hold it alongside BRK.B as an income-generating complement that provides similar exposure to the Berkshire equity philosophy while delivering the 15% annual income that Berkshire itself never will. As Buffett has said explicitly, he will never pay a dividend as long as he is alive, and there is no reason to expect Berkshire's approach to change under the next generation of management in the near term either. For investors who want to stay philosophically aligned with the Buffett approach while generating real cash flow, OMAH is a specific and coherent solution. Now let's be direct about the risks, because any analysis that does not seriously address the downside is not doing its job. The first risk is NAV erosion from overly aggressive income targeting. At 15% annual income, OMAH is targeting a distribution rate that requires consistent and meaningful options premium generation. In periods of low volatility, where call premiums compress, the fund faces a genuine challenge in maintaining the 1.25% monthly target without either writing calls much closer to the current stock price, which significantly limits upside participation, or supplementing with income sources that might include return of capital. The fund is too new to have demonstrated how it manages this trade-off across a full market cycle. Investors should track the monthly 19A1 notices carefully to understand whether distributions are being funded from genuine options premium income or whether any portion represents return of capital that is depleting the NAV over time. The second risk is the covered call upside cap in strong bull markets. If the equity market enters a period of sustained strong appreciation, which history suggests happens regularly over multi-year periods, OMAH's covered call overlay will limit the fund's participation in that upside. Individual positions whose prices rally sharply will frequently have their gains capped at the strike prices of the outstanding calls. In those environments, an investor holding BRK.B directly without any options overlay would outperform OMAH in total return terms. The income collected does not always fully compensate for the upside given up, particularly in the strongest bull market years. The third risk is concentration. OMAH holds 21 positions, a relatively concentrated portfolio compared to broad market index funds. While those positions represent some of the highest quality businesses in the American economy, concentration means individual position risk is real. If Apple, which represents a significant weight in both Berkshire's actual portfolio, and therefore in OMAH experiences a major negative development, it will have a meaningful impact on the fund's NAV in a way that would be much more muted in a 500 stock index fund. The fourth risk is the fund's early stage. OMAH launched with $1 million in seed capital and has grown to a few million dollars in assets in its first weeks of operation. This is a genuinely small fund in the context of the overall ETF industry. Small funds carry operational risks. They may trade with wider bid-ask spreads due to lower liquidity. They may face pressure to close if they do not achieve sufficient scale, and their expense ratios are more burdensome in absolute dollar terms because the fixed costs of running an ETF are spread across a smaller asset base. None of these risks are fatal, and the early trading volume 30,000 to 40,000 shares per day in the first weeks suggests meaningful market interest that could translate to significant AUM growth if the first distributions meet targets. But investors should be aware they are entering an early-stage fund and assess their comfort with that accordingly. The fifth risk is the lagged replication of Berkshire's portfolio. Because OMAH is built on Berkshire's publicly disclosed 13F filings, which are released 45 days after the end of each quarter, there is an inherent lag between what Berkshire currently holds and what OMAH's portfolio reflects. If Berkshire makes significant changes to its portfolio, as it occasionally does, sometimes dramatically, OMAH will not reflect those changes until the next rebalancing cycle following the subsequent 13F disclosure. This is a structural feature of any ETF that replicates a public company's disclosed investment portfolio rather than tracking a real-time index. On Vista Shares as a firm, the company was founded by a team with genuine ETF industry depth. The CEO's previous company, Index IQ, was focused on liquid alternatives and was ultimately acquired by New York Life, not an outcome that happens to firms without credible track records and institutional quality products. The co-founder who led Tesla's operations as president brings a background in scaling complex technology companies and a research-oriented perspective on investment themes. The broader product philosophy, identifying genuine gaps in the investment product landscape rather than launching imitative Me Too strategies, is the right orientation for a new entrant in a competitive market. Vista Shares is not trying to be the fifth or sixth version of JEPI. They are specifically looking for combinations of underlying exposure and income delivery that do not currently exist in a high-quality form. The pipeline of additional income products beyond OMAH is worth understanding as context. Vista Shares has 4 additional income strategies approved and ready to launch, applying the same 15% annual income target framework to factor-based equity portfolios: a low-volatility factor fund, a quality factor fund, a momentum factor fund, and a value factor fund. Each would hold a large-cap equity portfolio tilted toward the specified factor and apply the same covered call options overlay targeting 15% annual income. This is a coherent and scalable product architecture, the same income generation mechanism applied to a range of systematically defined equity exposures, and it would give income investors access to factor tilts that are widely used in institutional portfolio construction, but have historically been unavailable in an income-generating wrapper at this yield level. On the AIS Artificial Intelligence Supercycle ETF that Vista Shares has also launched, it reflects a supply chain and bill of materials approach to AI investing that specifically tries to avoid the problem that many AI-themed ETFs have, which is that they essentially give you Magnificent 7 exposure at elevated expense ratios without genuine thematic differentiation. By mapping the actual supply chains of AI infrastructure, data centers, and semiconductor manufacturing, the AIS methodology is attempting to find the companies that are building the infrastructure of the AI economy, rather than simply the large companies that are using AI or have benefited from the broader AI investment theme. This is the kind of product development philosophy, starting from what is missing in the market, rather than from what is selling, that tends to produce genuinely useful investment tools rather than marketing vehicles. Let's bring this all together into a clear evaluative framework for investors considering OMAH. OMAH is worth serious consideration for income investors who want a well-curated equity portfolio with genuinely high monthly income and do not need to capture every percentage point of equity upside in strong bull markets. The underlying portfolio represents decades of refined investment thinking applied to identifying excellent businesses. The income mechanism covered calls on individual high-quality equity holdings is fundamentally sound and widely proven as an income generation approach. The 15% target is ambitious but structurally achievable from premium income generation under reasonable volatility assumptions. The team behind the fund has relevant deep experience in ETF product development and management, and the use case for existing Berkshire investors who want income is specific, coherent, and not available through any other vehicle in the market. The caveats are also real. The fund is very new and has no meaningful performance track record to evaluate. The 15% target will be difficult to sustain without any NAV impact in extended low-volatility markets. The concentration in 21 positions creates more individual stock risk than a broad index fund, and the early-stage size of the fund carries operational and liquidity risks that larger, more established funds do not. The framework for monitoring OMAH over time is clear. Watch the monthly distributions and the 19A1 notices to understand whether income is being funded from genuine options premium or return of capital. Watch the NAV trajectory to assess whether capital is being preserved or eroded over multiple market environments. And compare the total return price appreciation, plus all distributions against both Berkshire Hathaway directly and against comparable income ETFs targeting similar yields to assess whether the options overlay is adding genuine value or extracting more than it contributes. At Dividend Desk, this is exactly the kind of new and genuinely interesting income product we will continue to track and cover as its track record develops. If it delivers on its premise, it will represent something valuable and novel in the income ETF space. If it does not, the early warning signs will show up in the data before too much capital has been committed. If this breakdown was useful, please hit the like button and subscribe to Dividend Desk so you never miss a video. Join the Dividend Desk community link in the description where we track income ETF launches, performance, and developments in real time as they happen. This is Dividend Desk. We will see you in the next one.